So in the mall strategy, that's the opportunistic side of shopping center real estate. Three strategies. One, harvest cash. There's many malls that are just fine. You're buying them at extremely high yield. You maintain, if not grow, net operating income, and you just have lots of cash. A second one is you buy something at a 15 cap and you've got Olive Garden or a Chick-fil-A that you sell in front in front of the property at a 6 cap, and you return money to your lender and investors. That's an arbitrage strategy. And then you've got redevelopment. You shrink retail and you put in new retail, or you put in multifamily, or you put in hotels, or some combination of all that, because the properties are extremely well located. And many times the retail is just too big, and you can buy them at a fraction of their previous capitalization.
Totally.
And if you do so with local partners, you don't have an issue with rezoning. If there's any incentives, you have a best chance of getting incentives. And property taxes, sometimes they're valued really high. And if you buy it at a third of that valuation, your local investors can help you ascertain that your property taxes fall by 2/3.
This episode is brought to you by Pierre Tax and Accounting, led by CPA Eric Pierre, a seasoned accounting and tax expert with years of experience helping individuals and businesses navigate complex financial landscapes. Whether you need personal tax planning, business tax strategy, bookkeeping, or financial planning support, Eric and his team are committed to helping you protect and grow your financial future with clarity and confidence. To get expert guidance you can trust, check out Pierre Tax and Accounting at pierreaccounting.com. This episode is brought to you by my friend Silas Lagoy over at ForgeMark Wealth. If you're a high-income business owner or professional and feel like you're getting crushed by taxes, you're not alone. And more importantly, you're not stuck. ForgeMark Wealth specializes in advanced legal tax strategies and wealth planning designed to help you keep more of what you make, grow it efficiently, and actually build long-term freedom, not just income. If you're making serious money but don't have a real strategy behind it yet, I highly recommend connecting with Silas and his team. What's up, everybody? Welcome back to another episode of the Big Hitters Podcast. I'm joined by Andy Weiner, who has quite an extensive background in real estate and retail, and he has some pretty cool elements of culture for his company, along with helping his clients have success in their overall strategies. Andy, tell us a bit about Rockstep. Tell us a little bit about your company and a little bit of your story in terms of your career.
Sure. So Rockstep, first of all, Andrew, excited to be on the show. We are shopping center investors, have been doing it for 28 years, built or acquired about 10 million square feet of shopping centers. We currently have shopping centers in 11 states. Before that, I ran operations for our family-held chain of clothing stores. We had 159 clothing stores. So I grew up in retail. I grew up in retail real estate, retail store metrics, retail operations. I'm a retailer at heart, and I love retail. And I started this business, as I mentioned, 28 years ago. We've got about 100 employees. We're vertically integrated, and we invest in the shopping center sector in a geography that we call hometowns. These are markets that are generally smaller, secondary, tertiary markets, under 1 million, but above 100,000 in markets that have something vibrant that creates some kind of population growth. And that's what we do. Who we are is kind of the Rockstep name. The Rockstep is not a word you might have heard of before, Andrew. It is a dance move. Dancers know what a rock step is. It's not in the dictionary, but I like swing music, big band era, 1950s, 1960s, Frank Sinatra, Ella Fitzgerald, that Sammy Davis Jr. era. And when you rock step, when you're swing dancing with your partner, you're switching direction on count 7 and 8. 1, 2, 3, 1, 2, 3, rock step, ball pivot change. And so we use it as a metaphor to be nimble, to be light, to listen to the music in our industry. And Andrew, we got a problem. Okay, guys, we need a rock step. So we use it as a verb. We got an opportunity. We need a rock step. So that's where the name comes from. And then I wrote 26, that's a lot of them, rules of behavior, very, very detailed rules, which we call rock steps. And every week we have a rock step of the week. That's our ritual. And at 10 o'clock on Monday, the whole company gets on a call and we talk about this week, rock step number 4, practice A plusness. And somebody writes an essay and then they call it random people. What does it mean to you, Andrew, to be A plus in your personal life, professional life? And so these are the rules. This is how we build a team. It's how we manage conflict, how we build trust. It is by far the most important thing in our company. I'm passionate about it, to the mat, emotional, in tears. If you are going to come to an interview at Rockstep, and we are hiring, Andrew.
I love that. Thanks for dropping that in there.
We are hiring. We are hiring. We are looking for great people. You've got to study the 26 rock steps on our website, rockstep.com, and then come to the interview with what are your favorite rock steps and why, and what are your most challenging rock steps and why. And so to come to Rockstep, you got to be good, hopefully. You better be good at leasing or property management or accounting, whatever it is. To stay at Rockstep, you got to live by these rules. And we're required to live by these rules between us, with our investors, our tenants, our communities, our lenders, our professionals. We can be held accountable. We're not perfect, but I put this out there. I wrote every one of these 26 rock steps, word by word, sentence by sentence. And there is nothing that comes close to being as important to this company as these rock steps. And we've got people from Blackstone and Brookfield and CBL who, the big public REITs who I think one of the reasons they're here is because we really, really, really work hard to try to live by these rules.
What's up, everybody? This episode is sponsored by ExitWise. If you're a business owner thinking about selling your company, whether that's now or years down the road, you need to know what your business is actually worth and how to maximize that exit. That's exactly what ExitWise does. They help you prepare, position, and ultimately sell your business by assembling a world-class team of M&A experts around you, guiding you from valuation all the way through closing. If you want to know what your business is really worth and how to increase that number before you sell, go check out exitwise.com and get ahead of it. It's really cool. It's really unique. I mean, it's funny because my wife and I just did this like 5 or 6 day marriage intensive. And one of the things that they taught at the end was, line dancing. And that was one of the things they taught was a rock step. And
do they use the word rock step?
Yeah. 100%.
Okay. Great. Yeah, great. It's 100%. Not, you won't find it in the dictionary. You will not find it in the dictionary. Yeah. So I own the word rockstep.com. So
interesting. Okay. That's fascinating. So don't F with the word rockstep. Andy will come get you. So that's right. Okay. So your primary business activity is shopping centers. And then, so I'm understanding who are you targeting? PE firms? Like who is your ideal client? Who's investing with you guys to help in this space?
Yeah. So we have a fund. So let me, before I answer who's investing, let me add one other dimension. We buy grocery anchor, open air, non-grocery anchored, and enclosed malls. And enclosed malls, you can buy extremely cheap. You can buy them at a 15 cap, typically. Okay. Great locations, wonderful markets. And that's because these are distressed assets. They're getting repriced at a lower basis, generally around a 15 cap. And we basically do about 55% loan to value at 6.5% interest rate, which means we have a very high yield, cash on cash yield of over 20%, which just produces a lot of cash to our investors. So that's what we do. When we find a great asset in what's called a hometown market that has population growth, something driving growth, university, hospitals, whatever it is. We also do something no one else in the country does, Andrew. We get local partners to be part of our equity. So I go out and I go meet the key business owners in the market as part of my due diligence. You, Mr. Owner of a steel plant, do you believe in this market? Do you believe in that intersection and that property? And then sometimes, well, that's part of the due diligence. Sometimes they don't. Good to know. And sometimes they will say, yes, I'll come in on the deal.
Tell me about a time they said no. I'm just curious to hear about a story.
I don't believe in this community. Don't believe her. I'm here because I've got a business here. My kids don't want to be here. Everybody's moving to the big city. Not good.
Yeah. Not something you want to hear if you're thinking about investing in their real estate.
Yeah. And even though the property might perform to give you a decent return, not good. Okay. So we're the only ones in the country that goes and gets strategic partners, local partners who can help us with incentives and entitlements, property taxes, leasing, and it's just heavy hitters who can help us lower risk and improve returns. And in markets where they want to own a piece of a property that affects quality of life. And there are two buyers in the market who are asset depletion buyers, and they're very active. And so we can help a community and a local group of investors keep the property away from asset depletion buyers. So that's kind of our model. It's a very unique model, the Rockstep strategy, the Rocksteps, our geography of secondary, tertiary markets, hometowns, asset class of malls and open air center. Malls are mid-teens cap rates. Open air centers are 8 to 9 cap. We have positive leverage. The shopping center sector, Andrew, was out of favor until about 3 years ago. Interest rates rose, and people who had invested in multifamily and industrial got the squeeze. And that's kind of what's happened the last 3 years. The shopping center sector is where the yield is. It's the yield play because two things have happened. One, you've got positive leverage. Your cap rate, your yield, what you buy it, is higher than your interest rate on debt. You put debt on the property, you improve the return to an investor. In the multifamily space, you might have a multifamily asset at a 4.5 or 5% interest cap rate yield, and your debt sometimes is higher than your cap rate. And so you apply debt, you hurt the returns to your investors. So that's negative leverage. You want to make sure you got to do positive leverage. That's key. The other thing about the shopping center sector is that the Amazon effect has matured. Amazon killed the weak players, particularly with COVID. Amazon plus the double whammy of COVID killed the weak players, and those that are left have figured out their own e-commerce strategy, their own e-commerce distribution network. They've got great apps, and they're holding, if not expanding, market share against Amazon. And their balance sheets are strong, and they're telling Wall Street, you know what? We're TJ Maxx, we're growing at 140 stores each year. We want to grow. Ross, 110 stores. Burlington, 90 stores. Nordstrom Rack, 30. Aldi, 240. And this is per year. Okay, so you've got dozens of these companies with great balance sheets that are growing dramatically, but there's no new shopping centers. So unlike multifamily, where I can look outside my window in Houston, you see construction, there's always new multifamily and always new industrial. There's no new shopping centers. And as a result, if you own second generation space shopping centers, the supply demand is in your favor as an owner, as an investor.
This episode is brought to you by 10X Nerds. If you're a business owner doing real revenue, there's a good chance you're overpaying in areas you haven't even looked at. Things like credit card processing, insurance, telecom, and more. 10X Nerds comes in, audits your expenses across 30 plus categories, and finds immediate savings. And here's the kicker: they only get paid if they save you money. It's a complete no-brainer. If you want to keep more of what you make, go check them out at 10xnerds.com. This episode is brought to you by Rakowski Law Firm. If you're a business owner or have built a level of wealth, but you don't have your estate plan dialed in, you're exposed. Rakowski Law Firm helps families and business owners protect their assets, avoid probate, and make sure everything transfers exactly how it should. This isn't just paperwork, it's a real strategy to protect your legacy. If you haven't looked at your plan in a while or don't have one, go to rakowskilawfirm.com.
Question,
Well,
thought.
I was actually, one of the questions I had was, what's a very typical deal? I mean, I'm thinking in my mind, I am from Connecticut, went to college in North Carolina, live in Colorado now. I feel like I've seen almost every part of the country.
Yes.
And I think about all of these shopping centers that you mentioned, anchored by grocery stores. There's a bunch of them by my house.
Yeah.
What's a very typical Rockstep deal? I don't know.
A typical deal would be in a market of, let's say, 250,000 that has a major university, growing hospital system, major manufacturers or distribution centers, something driving population growth, high quality of life, low crime, committed leadership, buying an enclosed mall at the key intersection in the market at a 15 cap with stable income, local lender at 6.5% on a 25-year amortization, fixed for 5 years, and we're able to keep the property leased. If we can get one of the anchors back, that's upside. It's kind of hard to get the anchors back. And then we pay an 8 to 9% preferred return current, and we pay it quarterly. And then we return between 5 and 20% of original capital per year after the pref without a refi. That is a perfect deal. Other deals, we have malls where we're demolishing most of them and putting in a Target. Okay. And redeveloping them with a grocery store and a Target and new retailers. Others, you sell off part of the periphery and you return your capital back to your investors very quickly.
That's interesting. So some of those, because I do wonder about the malls, and I'm just completely naive in the real estate world here.
Sure.
So, totally, the ignorance is real. It's not feigned. It's actual. So the malls are getting scraped, and now they're flipping them into Targets is kind of what I just heard.
Yes. So in the mall strategy, that's the opportunistic side of shopping center real estate. 3 strategies. 1, harvest cash. There's many malls that are just fine. You're buying them at extremely high yield. You maintain, if not grow, net operating income, and you just have lots of cash. A second one is you buy something at a 15 cap and you've got Olive Garden or a Chick-fil-A that you sell in front at, in front of the property at a 6 cap, and you return money to your lender and investors. That's an arbitrage strategy. And then you've got redevelopment. You shrink retail and you put in new retail, or you put in multifamily, or you put in hotels, or some combination of all that, because the properties are extremely well located. And many times the retail is just too big, and you can buy them at a fraction of their previous capitalization.
Totally.
And if you do so with local partners, you don't have an issue with rezoning. If there's any incentives, you have a best chance of getting incentives. And, property taxes, sometimes they're valued really high. And if you buy it at a third of that valuation, your local investors can help you ascertain that your property taxes fall by 2/3. So commercial real estate, Andrew, is certainly an alternative to the market. The market's frothy. Generally family office and institutional investors like to put in 10 to 25% of their investment into alternatives. And then the advantage of real estate today is, with the big, beautiful bill from President Trump that was passed last year, about 70% of the investment becomes a passive loss in the year you make the investment. So if you've got passive gains, you can write, you can, you can get a shield on those gains. You invest $1 million, you get a passive loss of 700,000 in year one. That's what the big beautiful bill does, combined with what's called cost segregation, to basically provide significant passive losses to offset passive gains, not capital gains, but passive gains. So people have passive income that need a shield. Commercial real estate's pretty strong right now for a tax shield.
I like it. Andy, what's something that you feel like is going really well with your company now? And what's something that you feel like is maybe a challenge or a barrier you're trying to overcome?
Yeah. So what's really going well, Andrew, is the people side of the business. We have got an amazing team. I mentioned the story of the rock steps and these 26 rules. It's a ritual. It's fierce. We hold people accountable. I get called on it, and it's really fun to have a high performance team and I've made my mistakes. I mean, we have Rockstep 22, don't be a jerk. And, I brought in somebody who I thought was a brilliant person to transform the company, but he was a brilliant jerk. And it didn't work out, and it was a mistake. And so the modification on the Rockstep is not only no jerks allowed, but no brilliant jerks allowed. And I would say that was a mistake that I've made. And the most important thing for our company is the rock steps. It's who we are. It's how we treat people. It's how we treat investors and communities and tenants. The shopping center sector was out of favor until about 3 or 4 years ago. Most people in commercial real estate had invested in multifamily, and then multifamily took a huge hit with the rise of interest rates about 3 years ago. And the Amazon effect, as it matured with COVID, created this huge opportunity for shopping center investing. So, did I answer your question?
You did, yeah. You said the people side of things is going really well. I loved the little story about hiring the wrong person. I mean, I feel like every business owner can relate to that.
Yeah. And we know, don't be a jerk, and no brilliant jerks allowed.
Yeah.
We've got a great team. We've got people who live all around the country who operate remote, as well as in our Houston office. Our goal, Andrew, is to be the country's leading educator of shopping center investing. So we've got on our rockstep.com, our learning center, we've got well over 100 articles on every aspect of what is a shopping center, different types, key risks, terms, taxes, everything associated, good and bad, with investing in shopping centers. And then we also have a videographer. You just met him earlier, and we produce videos. I'm the shopping center guy on Instagram, on YouTube channel. On YouTube, we have the shopping center channel. So that's our channel. So we produce basically videos on everything associated with shopping centers. And so for people who want to learn, the important thing is to get educated, for people who listen into your show. And then we're here to answer any kind of questions, and I encourage people who like commercial real estate to at least think about investing in the shopping center sector. And there's some very good operators. We're not the only one out there, but it should be part of a diversified mix of people putting money into commercial real estate. Stock market is frothy. Who knows if it's going to continue to go up at the same rate it's been going up.
What is a big challenge you feel like you're trying to overcome right now?
I will tell you the biggest challenge, Andrew, is when you're buying distressed properties, particularly in the mall space, the speed of acquisition, it's a 3-week cycle. 3 weeks from when you learn about an opportunity, you have to put eyeballs on it, you have to underwrite it, you have to come up with a strategy to build wealth for that asset and to create a story. And then in 3 weeks, you have to prove to the seller that you have your equity in place. And so what that means is it's so fast because it's usually lender driven and the process is so fast that only 3 or 4 or 5 people can play at that speed, not 50 or 100 like in a normal process in the real estate sector. Now, the result is that you're only competing with 3 or 4 people and you can get great deals. But the biggest challenge is how can you structure a team to move at speed and produce quality work? That is by far the biggest challenge. We have a great pipeline. We target basically 2x. People double their money over a 5 or 6 year hold, and with low leverage and with lots of cash flow. So the biggest challenge is executing on a mall pipeline when the seller, and most of the time the sellers are lenders, they want speed. And most real estate is done in a slower cycle. The buy cycle is, call it 2 to 3 months before you choose which horse you're going to use, a seller's going to go with, and then the closing process is usually 60 to 90 days all in after that. This one is lightning speed. So that's by far the biggest challenge, is operating at speed.
Let's talk about AI for a sec. How are you guys using it and leveraging it currently?
So what we're doing is we have an AI team and we're focusing on process throughout every part of the company. So in other words, going through process and then using AI. We've got an AI superstar who helps us. I mean, he's an external person, but as a consultant, and then other people in the company are using AI, as they can to improve the quality of their work.
Yeah.
So our goal is, as we grow, to simply make our people more productive and not increase at the same pace as we grow the number of people we got. Just make them more productive.
Yeah. I love that. What have been some of the key areas that you are using the AI in? Like, is there one area of your business, or is it content?
I would tell you that particularly in fundraising, we've been using it, and in definitely content, and I'm talking about written, video, and fundraising, where you're trying to identify who is most appropriate for investing in commercial real estate, in shopping centers, and also in our geography. We are a red state strategy, Andrew, or a red county in a blue state. And so our investors typically are business owners or family offices who like kind of conservative strategy, and they like cash flow. They're not, I'd say, we're not into sex. We're not into sexy property. We're into boring cash flow properties.
You caught me off guard with the not into sex thing, but I'm not gonna double click on that.
We are not into sex. Excuse me. We're not into that kind of sex, Andrew. Okay, if you know what I'm talking about. Okay, so I wanted to be sure I caught your attention there, Andrew. So
I'm sorry, I blacked out because of what you just said, but I'm okay now.
We don't like sex. We don't like sex. We like sexy properties. We like boring properties.
What's one thing we have not talked about today that gets you fired up?
That we have not talked about that gets me fired up? Well, the only thing I would tell you is that when you look at opportunities in the shopping center sector, there's one group of retailers that are bulletproof. and that are growing by collectively 300 to 400 stores per year. And that's the off-price sector. It's TJ Maxx with all their divisions of Marshalls and Home Goods and Sierra. It's Ross. They have a second division. It's Burlington. It's Nordstrom Rack. And these companies have figured out how to manage merchandise and how to turn their merchandise. Our company turned our merchandise, sold the average inventory at retail twice a year. Okay. These companies are turning their stock at 6 to 8 times per year. And they're creating excitement for women. That's the target customer. And they have a defense against Amazon. And it's really just transforming and have transformed the shopping center sector. It is the retail winner. You certainly have winners like Trader Joe's and Costco and certainly Walmart, Target. But this whole group of off-pricers is people we work with very closely, that we're working with all of them, and we're going to grow with them as they grow.
So, okay, now that is interesting to me. So you guys find a space that's big enough for them. One of your first calls is to a Ross or one of
Absolutely.
those types of interesting.
Yes.
Oh.
Yes. And we know where they want to go. We actually want stores to close so we can put them in. It's, and we're going to start, I think we'll end up doing some new construction for these tenants because they are they're telling Wall Street they have to grow and they're running out of opportunities. So they're looking at malls, they're looking at second generation space, they're looking in hometowns, and these companies are they mint money.
That's crazy. That is not what I thought you were about to say when you said bulletproof. I was like, okay, he's going to say Target, but that's so fascinating to me.
So take a look at a TJ Maxx. A TJ Maxx in 20,000 feet can do, let's call it 8 to 12 million. That's a good store, not a off the chart store. A Macy's or a Dillard's that is 100,000 feet might do 10 million. Okay. And this is 20% of the size. And they're turning their stock. They're getting people excited. They're getting women to come in again and again. TJ Maxx has, and this is a story about my wife. They have a separate division called the Runway, where they go after merchandise from Neiman's and from Saks and Bergdorf Goodman's and Bloomingdale's to the highest end. And they put them into 100 out of their 2,000 stores. They put them into those stores. There's 3 in Houston. There's 6 in New York City. There's 4 in Atlanta. I mean, there's runways, and there's a certain section of the store where they might have a $700 dress that you can buy for $99 with a name brand that they saw at Saks. And very frankly, there's not much more that gets my wife excited than doing that. Now, hopefully I get her excited, but that really gets her excited, Andrew. Okay. And so women all around the country who like these amazing deals know about the Runway. So now you know.
Andy, if people want to learn more about who you are and what you do, where can they go?
Rockstep.com. Remember that's the dance move, Rockstep. Go to our learning center. And if they certainly want to explore our fund, just make an appointment with me. You do it right on the website. And I can see if, certainly our goal is to educate people and see if we're a good fit for where somebody is thinking about investing right now in commercial real estate.
I love it, guys. Well, go check him out. And apparently he's got a pretty big following on Instagram too and YouTube. So go check him out there.
Please subscribe to the Shopping Center guy on Instagram, and please follow us on the Shopping Center channel. And great. Hey, Andrew, cool. Thanks. It's a pleasure.
Yeah, thanks for coming on the podcast. Don't go anywhere because I want to keep talking, but thanks for coming on the show.
I won't go anywhere, Andrew.